Hello and welcome. I'm Noel, and I'll be your guide through this presentation on the performance characteristics of Asia Pacific's REIT markets. If you have any questions, please email them to me at noel.neo@apria.asia. APRA members would be able to access a copy of this presentation deck through the APRA Research webpage. The analysis will draw primarily on the Thomson Reuters GPR APRA Investable REIT 100 Index, so let's start with an introduction of the index, before moving on to an analysis of the performance of Asia Pacific's REIT markets, delving into country-level performance, and looking at recent market trends. There are three things you need to know about the methodology behind this index. First, it is a free-float market cap weighted index. Second, there are rules around free float market capitalization, including a minimum of 50 million US free float market capitalization and a minimum of 15% free float. Third, only the 100 most liquid REITs that meet the aforementioned criteria will be included in the index. And how is this index relevant to you? Well, it is uniquely designed and maintained by a committee of fund managers investing in Asia Pacific's REIT market. This committee includes such renowned managers as John White of Heatman and James Maydew of AMP Capital. Pertaining to its uses, the index can be used as an underlying for ETFs and derivatives. It is an appropriate benchmark for securities funds performance. It is a useful tool for corporates in their investor relations. As you will discover in the course of this presentation, it is a great platform for research and analysis. It is also a means for investors to conduct asset allocation. On its composition, the developed markets of Australia, Japan, Singapore, and Hong Kong make up more than 90% of the index. You should note that geographical categorization is by country of operations rather than country of listing. On sectors, the largest is retail, followed by office, diversified, and industrial. Plotting total returns of Asia Pacific REITs against that of other asset classes over a 10-year period, we find that the risky assets like real estate, REITs, and equities have outperformed bonds. What is more interesting is that both real estate and REITs have outperformed equities. Breaking total returns of REITs down to its components, we find that REITs offer healthy income returns that has averaged 6.6% per year. Outperformance has been driven by capital appreciation to the tune of an annual average of 11.3%. If you look to the top right of this slide, you would notice the heavy capital appreciation flavor of Asia Pacific REITs is captured in their having a level of volatility similar to equities. The volatility of REITs remains lower than that of the broader real estate index and is higher than that of government bonds. Because of their income return component, Asia Pacific REITs have been more correlated with government bonds than with equities for the past 3 years. This is in part due to the common impact of QE across yield assets, so please note that this relationship could evolve as market conditions change. Now, drawing your attention back to the left of the slide, you see a chart that plots total return against volatility of the various asset classes over a 3-year time period. You would notice that Asia Pacific REITs have excellent risk-adjusted returns. In fact, if you plot a trend line through the scatter plot of the 4 asset classes, Asia Pacific REITs is the only asset class to appear to the favorable top left of the trend line. Moving now to country-level analysis, we have indices for Australia, Japan, and Singapore. The largest property sector in Australia is retail, with such groups as Westfield Group and Westfield Retail Trust. In Japan, office is the largest property sector, and in Singapore, industrial, with such groups as Ascendas and Mapletree. Plotting total returns of the three countries from 2006, we see that they have performed roughly in line leading up to the GFC. In the post-GFC period, however, Singapore has largely pulled away from the pack, perhaps due to Singapore's largely endogenous interest rates, which have reached record lows. Breaking out total returns to its components, we find the bulk of the recovery occurred in 2009, the period immediately after the GFC. It is somewhat surprising to find Singapore has higher income returns than Australia, even though domestic interest rates are higher in Australia than they are in Singapore. By charting yields of property sectors by country and ranked according to the property sector's weight in that country's index, we realize that a contributing factor is the sector composition of the respective REIT markets. Singapore's largest property sector is the high-yielding industrial segment, while Australia's REIT market is dominated by lower-yielding retail. You would also be aware of a market correction from April to July 2013. We drill a little deeper and realize the market correction was broad-based across all countries. However, if we examine the performance of individual securities, we discover that the underperformers are concentrated in Japan. This suggests that for Japan, a pullback post the initial Abenomics rally is an influencing factor. A present market concern is the impending scaling back of QE. By comparing the Asia-Pacific REIT yield against that for 10-year US Treasuries, we notice a sharp dichotomy between the pre- and post-GFC periods. REIT yields were in line with Treasury yields pre-GFC, alluding to a lack of risk premium or pricing in of future REIT capital appreciation. The situation changed post-GFC, with investors continuing to demand a risk premium for REITs despite the recovery in REIT values. The yield spread today is near the 10-year average, spanning both pre- and post-GFC periods. This analysis, however, compares across two separate and distinct geographical regions. We next examine yield spreads for individual countries in Asia-Pacific. We see here that a significant risk premium is also demanded at the individual country level. Yield spreads are low relative to the post-GFC period, but are high when compared to pre-GFC. The future path of yield spreads would depend on how investors weigh the riskiness of REITs relative to their growth prospects. To end, I'd reiterate the three main findings of this analysis. First, Asia-Pacific REITs offer strong income returns and deliver outperformance through capital appreciation. Second, they have outperformed equities and bonds on a risk-adjusted basis over a 3-year period. And third, because of their high income return component, Asia-Pacific REITs have had higher correlation with bonds than with equities for the past 3 years. If you require the data used in this presentation for your own analysis or tracking, this slide displays the Bloomberg ticker codes of the investable REIT index. Should you have any questions, please feel free to send me an email at noel.neo@epra.asia. Thank you very much for your time today, and I hope you found this information useful.